Thank you, Jay. Our next speaker is Ken Fisher. Ken Fisher is the founder, executive chairman, and co-chief investment officer of Fisher Investments, a $100 billion global money management firm serving large institutions and high net worth individuals throughout most of the developed world. Mr. Fisher wrote the Forbes portfolio strategy for 32 plus years in 2017, making him the longest continuously running columnist for Forbes magazine in history. He now writes weekly columns for USA Today and Germany's Focus Money, and monthly columns in the United Kingdom's Financial Times, Denmark's Borsen and the Netherlands Telegraph, and Spain's El Economista. Mr. Fisher authored 11 books, including 4 New York Times bestsellers, and has been published, interviewed, and written about in publications globally. Ladies and gentlemen, please give a warm welcome to Ken Fisher.
Hi. So I never really say anything new. That's why I say so much. They give me 20 minutes up here, and that means I won't take questions here because it takes me at least 30 minutes to answer one question. But I do have a 12:30 workshop where I'll do a lot of visuals and questions and stuff like that. I really don't think a lot of new thoughts. Most of the things that I ever think were developed long ago, I heard about long ago, I put them together long ago. One of my all-time favorite people was John Templeton, who by happenstance shared my birthday, except he had it first. And one of his famous quote lines was that the 4 most dangerous words in the English language are, "It's different this time." And it's always different, but it's never different. And it's really about understanding what's basic, what's the same, what are the unimportant differences that superficially confuse us. I wrote a book once on 3 questions that actually was the best-selling book I ever did. And the one question was, what do you believe that's actually false? And the second is, what can you fathom that others find unfathomable? And the third's, what's your brain doing right now to screw you up? And most of the time, your brain's doing a lot to screw you up, and that's kind of where behavioral finance comes in. But if we've got visuals here, this is another one of Templeton's great lines. Oh, and I've got this 12:30 workshop where I actually can't answer questions. So I'm only going to use a couple visuals, but in the 12:30 workshop, I can use lots and lots of visuals. If you like visuals and you like questions, that's the place, not here. But Templeton's line that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria is always true, except when it's not. And most of the time it's true. When it's not is when there is something that I call a wallop, but you call it what you want, which is big enough, bad enough to turn normal global GDP growth into global recession. And that takes a lot. That happens. But in a world of $80+ billion global GDP, that normally in a normal year would grow in real terms at something like 2, 3, 4%, depending on where you are. That means having a few trillion dollars of big, bad, negative surprise that wasn't pre-priced. That's hard to do. It happens, but it's hard to do. Normally, you get to that euphoria phase, so one of the first things I always ask myself is where I am in that pessimism, skepticism, optimism, euphoria part, and we could argue about that. I don't really want to. My general sense is that we're in the optimism phase, and that we began in that in 2016 after a very long transition from extreme pessimism after the big bear market to a long slog through skepticism into early entry into optimism. But I don't believe we're in euphoria, because if you just were to pick up today's Wall Street Journal and look at the story on New Enterprise Associates, which is one of the classic legendary Silicon Valley venture capital firms. They're spinning off all of the startups from their last venture capital fund because there was enough of an IPO market to take them public. And so they're spinning them off into another holding that will hold them after the life of their partnership. That's pretty unusual. If you look at IPO levels in China, where they don't have the regulatory burden we have, they're pretty low. You'd think they might be higher if we had euphoria. We could go on and on about that. I don't really need to. I want to talk about something more basic. So I'm going to make you a solemn vow that the rest of our lives, you're never going to find any material time where the U.S. market goes one way for any magnitude and duration of any materiality, while the non-U.S. stock market goes the other way. They're going to go the same direction. Small single countries may be exceptions as they screw themselves over, or not. But the world as a whole goes the same way America goes, not because we drive it, but because we're one big block and it's another big block, and it's all like money running down into a lake. It's just like water. I learned that it was just like water when I was a kid. It all seeks its own level, and it's all about the competitive value of money. So I want to talk about the competitive value of money for a second, because it's really, really simple, and it's really, really basic, and most people don't think about it. So some apples are a little different than other apples, but they're all apples. When we look at the global stock market, you've got different sectoral makeup inside of America than outside. America is just the tech capital of the world. I'll come back and talk about the Cape-Shiller PE that you've all heard about, which I consider largely ridiculous. But I want you to kind of just get one piece of why it's ridiculous, because it's predicated on history from a world where the tech world was not very big. And today, of course, the tech world is primarily America, and is the second biggest sector, and is, for logical reasons, hugely priced in PE compared to other portions of the market. When you look outside of America, valuations are somewhat lower, which is not a statement that outside of America is a better buy. It's a statement that it's got a different sectoral makeup. And you have to think about those valuations based on what they're valuing, not the totality of the two on a comparative basis. But when you put them together, the PE of the world is about 15. Now, I never liked PEs. I kind of got my breakout in life attacking PEs. But PEs have some use, and of course you all know what PE is, so I don't have to go into that. I always took the PE and flipped it into an EP. Now, the PE or the EP is an after-tax number. So if you got a PE of 15 and you flip it into an EP, that's an earnings yield of 6.6% roughly. That's the after-tax return that we would get if we owned the whole global stock market. And from here on out, the price never went up or down, and the earnings never went up or down. We'd be collecting 6.5% forever, and if we owned the whole thing, we could do whatever we wanted with it, right? As long as we owned it, it's ours. Now, I want you to just think about that for a second, because I don't think most people do. I can go out and I can buy long-term debt, or I could issue long-term debt at 4%, corporate, good grade, junk at 6%. You remember the way a balance sheet works. Junky equity is one step away from junky debt. and they compete against each other in price directly. So what does that mean? Think about it, because I do believe this is really simple and really basic, and almost no one fully gets it. You get a lot of these idiots that say things like, my USA Today column this week is attacking Senator Rubio, not for partisan political reasons, because I don't go there, never have, but because he does not appear to have any basic economic education at all, which is true of most cradle-to-grave politicians. I just want to attack Rubio a little more, just in case any of you are from Florida. I mean, this is a guy that got a political science degree, then he got a law degree, then he spent 2 years lawyering, then he got elected and has been an elected politician ever since. And he has no basic education in economics, and he has no real-world experience, and he thinks he's going to tell us about tax policy. You follow the lunacy of that? In terms of doing what you know, doing what you've been trained for, doing what you have real-world experience in? But there's a lot of people that say things like, corporations are spending way too much on stock buybacks and dividends, and they're spending more on that than their earnings, which is a completely misguided concept. Let me take you through that. So we borrow money at 4%. We're a corporation. We got an average valuation. We're an average global company. Our PE is 15. We're not a tech company. We're not necessarily an American company. PE's 15, that's 6.6% after-tax earnings yield. We borrow money at 4%, that's a pre-tax number. American corporate tax rates and most European corporate tax rates, that's about 3.2% after-tax. I just want you to think about that. We borrow at 3%, we buy back our own stock with an earnings yield of 6.6, and we get more than 100% immediate markup. We take the shares that we buy back and we destroy them. We reduce the shares outstanding while we're actually making more money because of the spread between the 3.2 and the 6.6, that 100+% markup. Our earnings per share go up, and our capital structure actually improves. When I was a boy, Modigliani made it very, very clear, and has been true ever since, although most people forget this, that the trade-off on the margin between debt and equity is a competitive pricing trade-off. When the spread between the earnings yield and the bond yield is that big at the corporate level, and a corporation deploys that, they actually are improving their capital structure. Even though most of us believe that debt's bad, more debt's worse, and too much debt, you go to hell. You might go to hell, but not until you die. So what does that do? That has companies doing buybacks and cash-based takeovers. When do you get euphoria? You get euphoria when you have a lot of equity-based takeovers, right? As opposed to cash-based takeovers. I want you to think about that for a second. We can go into more detail if any of you want to come to my workshop, but I just want you to think about that. Might long-term rates go up? Yeah. Might bad things happen? Might there be a wallop? Yeah, that's all stuff worth thinking about. But fundamentally, as long as the earnings yield, bond yield spread is huge. Let's play takeover for a second. Let's say we borrow long-term money and we take over another company with the same PE we have, and we're average. We're not good. We're not great. We're just average. At that level, with the average PE and the average borrowing rate and a 25% markup, we still get an immediate 65% markup on the money. It's still profitable. Why shouldn't they do that? They should. It's right. It's profitable. It's moral. To Gene Simmons' point, it's selfish. That was funny. You don't like my sense of humor. That's okay. Most people don't like me anyway. I talk about finance. It's mostly boring. Usually when I talk, it's a really good opportunity, particularly with these low lights, to fall asleep. Won't be as good in the workshop. Then you have to actually pay more attention to me. It's very annoying. Let me spend a couple of more minutes on thinking about this in a different way. You've all got this ridiculous notion that high PE markets are more dangerous and scary than low PE markets, right? And you've all been trained that, and the media tells you that. And that's been reinforced with the Cape-Shiller PE that I'm sure most of you have heard about because the media can't stop talking about it. And there's a historic truth to the Cape-Shiller PE. But as I said, it's comparing a world from a past to a very different world today, and it's not taking into account for adjustments in interest rates. But I just want you to think about PEs for a second, simple PEs, and then we can go to a more complicated one because the Cape-Shiller PE is a complicated one. You see how this kind of looks like a shotgun blast with really fine pellets? If you cannot see that this looks like a shotgun blast with really fine pellets in a very mild wind, don't drive a motor vehicle home today. The fact of the matter is that when you look at it, each one of these dots represents the price-earnings ratio of the market on January 1st and what the market did in the subsequent 12 months. The scale on the left, of course, has got positive numbers above zero and negative numbers below zero, and PEs down at the bottom. The R-square on that is 0.0, and this is a history of all of the market's PEs from 1873 using the standard data. But you can cut it in almost any other time slices you want, and you get the same thing. This is 12 months. If you use 3-year data, and a buddy of mine and I published this in the Journal of Portfolio Management a decade ago, and this stuff was all out of my Only 3 Questions book also. 3-year data has still got a single-digit R-square. 5-year data still has a single-digit R-square. For every level of absolute PE where you can find the market having done well from that level, high or low, you find an exactly comparable level that did comparably poorly. I just want you to think about that when so many people are concerned about the market's PE. If we were in euphoria, there wouldn't be a lot of people concerned about the market's PE. You follow that? It's that people are concerned about it. So now we've got the Cape-Shiller PE, which guarantees us a lousy 10-year return. Fair enough. I don't buy the concept. But in the same work, you take the Cape-Shiller PE data exactly as Robert Shiller constructed them originally, and you look at the 1-year returns, and you know what the R-square is? Take a guess. 0.0. You look at the 3-year returns, it's a single-digit number, which means it doesn't mean anything. You look at the 5-year returns, it's still a single-digit number that doesn't mean anything. And I posit to you, although I may be wrong, that for most of you, and for me, if the market was to go seriously one way for the next 5 years, but the reverse way in the 5 years after that, it would have largely driven us crazy in the next 5 years, if that makes sense to you. If the market's really strong in the next 5 years or really weak in the next 5 years, but the 5 years after that goes the other way, and we're on the wrong side of the next 5 years, we're going to have a hard time. In the institutional world, that's a big part of my business, you just get fired. So I'm coming to the end of my time here, and I haven't told you anything really that I didn't know when I was very young. I just keep saying it over and over again in different ways in places like I did for a long time in Forbes and now in my USA Today column and in other columns. And I really think this is a beautiful time. And I want you to think back to a time 22 years ago in 1996 when we had what were perceived of as high PEs, when Alan Greenspan was talking about irrational exuberance tied to the Cape-Shiller PE, when we had a global expansion that was perceived soon thereafter as a Goldilocks world, where growth was good but not too high, inflation was good but not too high, unemployment was good but not too high. The prior recession that Europe had had was over. Personally, I believe we're in a Goldilocks world right now. that most people don't recognize yet as a Goldilocks world. And when they do, I believe we'll move from the optimism to the euphoria. And I think the Goldilocks will become apparent. And I think you want to think through, and I'm just going to say this and I'll be off the stage here in 30 seconds. Most of you wish that was a long time ago now. I'll just say very simply that what I think you ought to do in the period ahead is expect a good market in equities, but keep it really simple. Don't try to do anything fancy. Don't try to do anything extraordinary, because the extraordinary things get hard to unwind when the time comes to unwind them. The simple things, big, easy, simple stocks, for you are easy to get out of when the time comes. And I urge you, normally in the last part of a bull market, the last third, the kinds of stocks that do best are big, simple, and you could envision them best this way. The easiest ones for the last greater fool who gets in after the top but doesn't recognize it, wants to buy. Those are the stocks you want to own now, because other people are going to bid them up for you. Then when the time comes that there's a different world, they're the easiest to get out of. So with that, I want to thank you for listening to me. If you want to come to my workshop at 12:30, that'd be great, and I'll see you there and around. Thank you.